Come to the next chapter, mutual fund. This chapter is very similar to your group 1 SFM, but more detailed than the group 1 SFM because this is special topic now. So we are going to learn all types of schemes in detail and some recent SEBI amendment also with respect to mutual fund, right? We will learn calculation of NAV, calculation of return, and like in group 1 you have Sharpe ratio, Trainer ratio, Jensen's alpha. So all those calculations will again be covered in this chapter with some focus on the regulation aspect also. Okay, mutual fund is one of the most growing industries. The total asset under management, AUM, asset under management, have crossed more than something like 10 lakh crore for all the mutual fund put together. Individual mutual funds also have asset under management of 2 lakh crore or more than 1 lakh crore now. Okay, some of the big mutual fund houses like HDFC or Reliance or ICICI, so their asset under management has exceeded now lakh or 2 lakh crores of rupees, of course spread over different schemes. So what is a mutual fund? Mutual fund is a financial intermediary. At present it is registered like a trust in India. Okay, there is a sponsor who starts this mutual fund and then they collect saving from a large number of investors. Investor can be small, okay, or corporates also, high net worth individual also like you, who will invest their money. These mutual funds are run by professionally qualified managers who have got experience in the field of investment. So they will invest your money in different types of capital and money market instruments. Like for example, they'll invest in share, debenture, bonds, commercial paper, certificate of deposit, treasury bond. This investment will generate return and this return will be distributed to the investors as income. And again the income, if he wants, he can reinvest that amount in the mutual fund again. So this is how a typical mutual fund operate. Mutual fund raise funds from large number of investors through the units. They issue something called units that shows your ownership in that scheme, proportional ownership in that scheme. There are specified schemes and that is what is going to be our topic today, different types of schemes. Schemes means where would this mutual fund invest, so that you know risk and return, so that you can invest according to your liking. So they will clearly mention what is that scheme, where the fund is going to be invested. They can invest the funds in different securities which gives him return by way of dividend, capital gain, etc., interest, and then after deducting their expenses, AMC fees, asset management company fees, the returns are distributed to the unit holders called investors. So when will the investor make money? When the mutual fund generates higher return. Mutual fund will generate higher return if they invest properly, if the fund manager is skillful. Okay, why do you think we should invest in a mutual fund? Why? How does a mutual fund work? Okay, already discussed. Once again, mutual fund will pool the resources of a large number of investors. They are managed by professionally qualified, skilled, experienced people who know when to invest, where to invest, when to sell, in what combination to invest. They issue units to the investor. The unit holder becomes a part owner of the asset of that mutual fund scheme. Okay, fund managers invest in different types of scheme. If the value of the mutual fund investment goes up, investor earns more return. If the value of the investments fall down, the investor lose money. So this way the investor earns income. If the mutual fund manager is good, he earns high return, unit holder will also earn a high return. So if you don't want to invest directly in the capital market, okay, suppose you are Virat Kohli, VK, Virat Kohli, you earn 150 crore rupees per annum, just this much, but you don't have time. So will you invest in share market? No, it requires lot of skill, understanding and time to directly invest in the capital market. Which share you should buy, when should you buy, how much you should buy, when should you sell. So many options are available. Even if you invest in the 50 shares of Nifty, that also requires skill. Out of 50, which one, how much, when to buy, when to sell. Why to take such headache? You can invest in a mutual fund. The fund manager will charge a small fees. Again, the cost is usually lower than direct investment also. If you invest directly, you have to pay brokerage, both at the time of buying and at the time of selling. Here you have to pay some fees to the fund manager. This is not free of cost, but it is relatively lower cost. And then the fund manager would manage your funds, because his success also depends on how much returns he can generate in a year, so that in future more and more people would join that mutual fund scheme. So investing in mutual fund is an expert job in the present market scenario. A systematic investment in this instrument is bound to give rich dividend in the long run. That is why over 2 crore investors have faith in mutual fund. So in India right now, the statistics suggest approximately 2 crore investors invest in the mutual fund, which is very large number. 2 crore investors, small considering the population. You see the type of country also, na? India is a poor country. Literacy rate is low. Confidence in mutual fund scheme is less. So if you see bank deposit, FD, post office deposit, they occupy large chunk. Only qualified and talented people like you invest in mutual fund. Okay. So go to your society where you stay. Ask 10 people how many of them invest in mutual fund. You will get the ratio. The first thing they will say, what is mutual fund? That is a problem. Nobody understands this product better. So now the government, RBI, SEBI, MFI, they are doing a lot of promotion of the mutual fund, trying to explain in simple language so that more people can be attracted towards mutual funds. Anyway, who can invest in mutual fund? Anyone with some money in his pocket can invest in mutual fund. There is no restriction on the type of investor. Anybody with the investment surplus. And one advantage of mutual fund investment is you just need some amount of money, maybe say 5,000 rupees, your 1 month stipend, invest, okay, by buying a particular scheme according to your objective and strategy. How mutual fund work for you? The money collected from investor is invested by the fund manager in different types of securities. You don't have to worry. Once you invest in mutual fund, relax. Your money is in the hand of qualified, skilled, experienced, talented fund managers. They will now take all the investment decisions. They will invest in share, debenture, bond, treasury bill according to the scheme and according to what he feels is good at that point of time. And then the fund will generate income. This income and capital appreciation, after deducting the expenses, is distributed proportionately to the unit holders. Okay. One question which people will ask you once you become CA, now also, because they might be thinking you are a CA now, they ask you this question: where should we invest? Bond, stock, mutual fund? Yes or no? Do you come across such queries? What is your suggestion? Between stock and mutual fund, which one he should suggest? To ask him few questions. Do you have the time to pick the stock? Do you have time? Because if you want to choose the stock yourself, you need to spend lot of time in reading newspaper. Newspaper means you have to read the company related news. Okay. Not Rahul Gandhi, Amit Shah, Modi, Kejriwal, Mayawati, Chandrababu Naidu. What company is doing, how much profit they have earned, how much dividend they have paid, what is their market price. Read the related magazines also. Okay. Read the annual report of the company. Then they will ask, what is annual report? Some people can ask you this question. Quarterly updates. Listed company gives you quarterly updates. What was the profit in that quarter? Cash flow, balance sheet, industry report. If you want to invest in automobile company, what is the industry report? How is it going to perform in the next few years? And talking to the people who are familiar with the industry practice. Do you have time for this? Ask him. If he says yes, okay, then you can go for direct investing. You have to be an active investor if you want to invest directly. Active investor means you have to continuously monitor your stock. Spend some time every day or every week in checking whether your stock is performing as per expectation or not, or should we change it, which means continuously monitor the stock you pick and make changes, more, buy more, cut exposure depending upon the turn of the events. Can you do that yourself? Can you do that yourself? If yes, you can invest in the stock. Investing is an art. Investing is an art. It requires time. It requires time. Second question you ask, do you love the thrill of ups and down of the stock market? Yes or no? If it is no, I am worried. Sometimes Sensex crashes by 800 points. My value of the investment goes down by 20% and I feel very shocked. Dear student or dear friend, remain away from direct investing. If you are investing in the stock market directly, be ready for the volatility. It will be there. Do you find yourself turning into business channel and scouring business paper hoping that you can pick the next Infosys? It means that do you spend time in business newspaper, business magazine, business news channel, and you are searching for a stock which will become the next Infosys. Means if you invested 1 lakh rupees 20 years ago, now it is worth 1 crore rupees. You have to find such stock. Can you do that yourself? If you have an instinct for spotting the stocks and importantly the discipline to act on it. If you have the emotional maturity to cut your losses when you are ahead, then you can trust yourself to invest in the stock. So if you have the above feature in you, you are going to invest in the stock market, then you are meant for stock market investment. But you are a Virat Kohli, Anushka Sharma. Where do you have time to read newspaper and annual report? Okay. So for you, the best is leave your money in the hands of professionals and who are subject to regulations. So they won't misguide you or cheat you. Mutual fund could be the best avenue for the risk averse investors. So you want to enjoy the benefit of capital market also, but you don't want to take all the hassles of direct investment. Then dear investor, mutual fund is for you. Okay. Now let us quickly have a look at growth of mutual fund industry in India. Quickly. This is not a conceptual topic now, it is just a fact based. What happened from 1963 till today? So when was the first mutual fund started in India? 1963. What was the name of that mutual fund? Unit Trust of India, popularly called UTI. And who took the initiative to start it? GOI and RBI. In India, the history of mutual fund growth can be divided into 4 phases. History of mutual fund starting from 1964, as I said, up to 1987. Okay. During this period, there was only one mutual fund. Which one? UTI. UTI was established in 1963 by an act of parliament. So this was the only mutual fund, monopoly. There is no competition. Okay. So who was the regulator of UTI at that time? Now remember, the regulator has changed now. Earlier only UTI was there. So regulatory and administrative control was with RBI. Then in 1978, UTI was delinked from RBI. And the Industrial Development Bank of India, IDBI, took over the regulatory and administrative control in place of RBI. So the administrator changed because RBI is overburdened with so many other things. The first scheme that was launched by UTI was Unit Scheme 1964. This was the first scheme. And for information, it has become very popular. It had become very popular at that time. Okay. And now towards the end, that is 1988, when the monopoly of UTI now will collapse, UTI had at that time 1988 6,700 crore rupees of asset under management. At that time 1988 they collected 6700, which is a big achievement. Then the second phase started in India in 1987 up to 1993. So during this 6-year period, government allowed other public sector units, banks, to start their mutual fund because government still did not trust the private sector. More mutual fund, but all under government control only. So 1987 non-UTI mutual fund started. These were set up by public sector banks. So State Bank, Canara Bank, they started. Plus even the insurance companies like LIC and GIC, they started their mutual funds. So SBI mutual fund was the first non-UTI mutual fund. So what is the sequence? First UTI, SBI, established in June 1987, and then it was followed by Can Bank Mutual Fund, December 87. Can Bank means Canara Bank. Punjab National Bank Mutual Fund, August 89. Indian Bank Mutual Fund, 89. Bank of India Mutual Fund, June 90. Bank of Baroda Mutual Fund, October 92. All these are public sector banks. Okay. That means the competition started in the mutual fund industry. And LIC had established the mutual fund in 1989. GIC started mutual fund in December 1990. Now what was the assets under management with these mutual funds at the end of 1993? You must have read some time back 4,000 some crore. Now it is 6,000 some crore. Now it is 47,000 crores. 7 to 8 times in a span of 6 years. Okay, now the real competition began after 1993 when private sector mutual funds started. This period we had liberalization, globalization. Is it right? Restriction on mutual funds were reduced. Private parties was allowed. And this period marked a new era started in the Indian mutual fund industry. giving the Indian investor a wider choice of fund families. Now the problem is some interesting thing you should know. Why did government started UTI? Because that time investor did not know where to invest. So government said, you invest in UTI and we will invest in shares according to our professional management. Now the problem is there are so many mutual funds. Now the investor is asking, this is the investor, where to invest, in which mutual fund to invest. Okay. So the solution which was created in 1964 became a problem in 2003 because there are so many mutual fund houses now in India that he is spoiled for choice. He has plenty of choice now. So also 1993 was the year in which first mutual fund regulation came into being, under which all mutual fund except UTI were to be registered and governed. So UTI was still outside the purview of this SEBI regulation. Because now private sector have come, so there must be regulation. Otherwise they will collect funds from large number of people and they might just vanish. So strong regulation was there. But UTI was kept outside because it was under government control. The erstwhile Kothari pioneer, now merged with Franklin Templeton, was the first private sector mutual fund registered in July 1993. So which was the first private sector mutual fund? Kothari Pioneer. First non-UTI mutual fund? SBI. First mutual fund? UTI. Okay. But this Kothari Pioneer does not exist anymore. It has been taken over by Franklin Templeton. Then in 1993 is a historical year as far as mutual fund industry is concerned, because mutual fund regulations were also introduced by SEBI. The industry now functions under SEBI Mutual Fund Regulation 1996. So dear student, you have to know some basic provision of this law also in your current syllabus. Okay. Mutual Fund Regulation 1996. The number of mutual fund houses went on increasing because now private sectors are allowed. So Tata Mutual Fund, Birla Mutual Fund, Reliance Mutual Fund, Axis Mutual Fund, HDFC Mutual Fund, ICICI Mutual Fund, Kotak. So every big corporate house, they started mutual funds also, so that they can get money from this mutual fund indirectly into their respective businesses also. That you don't have to write. Okay. What is the hidden agenda? Mutual fund will raise money and that money can be given to the group companies if required. The number of mutual fund houses went on increasing with many foreign mutual funds setting up funds in India. So during this period, one more major event took place. Foreign mutual funds like Franklin Templeton, Fidelity, DSP BlackRock, they started. DSP BlackRock, Fidelity, Franklin Templeton, they also started. So that means the competition is further increasing now. Now you see the status: 33 mutual funds houses and managing asset of 121,805 crore. So again almost 2 to 3 times improvement. And during this period, that is around 2003, UTI was managing funds of 44,541 crore and it was the leader in the mutual fund industry around this time, 2003. But now it is no longer a leader. It has lost its leadership. In February 2003, following the repeal of the UTI Act 1963, so one fourth phase have started where the monopoly of UTI or the status of UTI has completely changed. Now the UTI is bifurcated into two separate entities. You don't have to write, but during this time there was a lot of irregularity in UTI, corruption, okay, mismanagement. So then government thought, let us do something radical. So UTI Act was repealed. UTI was divided into two units now. One is the specified undertaking of Unit Trust of India. So first one is called SUTI. What is SUTI? Specified undertaking, SUUTI. Okay. Specified undertaking of the Unit Trust of India. Something like this they used to write in the newspaper. SUTI. Not Chutti. With asset under management of 29,835 crore at the end of January 2003, representing broadly the asset of US 64 scheme, assured return schemes and certain other schemes. So some schemes were transferred to SUUTI. And the specified undertaking of Unit Trust of India functioning under the administrator under the rules framed by Government of India does not come under the purview of mutual fund regulation. So still this SUUTI is outside regulation. But the other part, the second part is called UTI mutual fund, which you see in the newspaper, the advertisement. Now this will be run now like a professional entity, sponsored by PNB, SBI, Bank of Baroda, LIC. It is registered with SEBI and functions under the mutual fund regulation. So in the fourth phase, the important event is UTI was bifurcated into SUUTI and Unit Trust of India. The first one is still under government regulation outside SEBI purview. Second one comes under SEBI purview now. So what you see in the newspaper, advertisement, etc. is that second one. Okay. What is the current status? The AUM of the asset management industry in India has grown to 8,252 billion INR in 2014. So if you multiply by 70, you will get the rupee value of that. While the AUM under, not multiply by 70, it is, you can say, how much is that? 8,25,200 crore. 8,25,200 lakh crore now. 8 times it has increased. Huh? Yes, 8 trillion. It has means what we studied in 2003. Now it is 8 times of that. Means leave the market to private sector and see what they can do. Is it right? The message is that private sector can change the rule of the game quickly, suddenly. Keep the market to private sector, like it happened in automobile, mobile phone, okay, telephony service, insurance sector, and the market has changed. So anyway, while the AUM has grown approximately 470 billion from 1993 to approximately 8250 billion in 31st March 2014, which means the compounded annual growth rate is 14.6% in this period. CAGR means compounded annual growth rate, which is very high. Sensex during this period has also grown tremendously. It was 2280 point in 31st March 93. Sensex is now 22,386 in 31st March 2014. But now it has crossed 37,000 also. Okay. The industry has seen net inflow of approximately 4,900 billion INR from 2001 to 2014. An average of 352 billion INR per annum. So what is your interpretation? That it is growing very rapidly and you can take the benefit of this industry now as an advisor, or maybe you can become the fund manager only, or you can start your own mutual fund. which is little difficult because they don't get licenses now. SEBI says this is enough. Now you play among yourself only. Okay. The mutual fund penetration in India is low as compared to global and peer benchmark. But if I look at the GDP and the asset under management, it is around just 7 to 8%. So your question was only 2 crore investors in mutual fund. Yes, it is very low. But if you look at the global average, 37%. If you compare with Brazil, which is similar to Indian economy, developing economy, there also the asset under management to GDP ratio is 45%. In an effort to increase investor awareness, if you see newspaper or TV channel, different types of advertisements are appearing relating to promotion of mutual fund. Okay, so whatever that investor education fund money they collect, they use it for this promotion of mutual fund also. Even in school, colleges, okay, they conduct conferences, seminar, and try to increase awareness about mutual fund. Now we'll continue in the next lecture.